1. The state of U.S. manufacturing amid Trump's tariff deadline. 2. Impact of Trump's tax law and tariffs on U.S. factory investments. 3. Will 90 deals in 90 days collapse disrupt global supply chains? 4. Why Trump's tariffs haven't boosted U.S. manufacturing jobs. Economic Analysis 2025. 1. The state of U.S. manufacturing amid Trump's tariff deadline. How robust is the manufacturing sector in the United States as the deadline for President Trump's tariffs approaches? As the global economy holds its breath, the impending July 9th deadline set by President Donald Trump for imposing significant tariffs on a majority of the nation's trading partners is creating a wave of uncertainty. On a recent Monday, Trump revealed plans to impose tariffs ranging from 25 to 40% on 14 different countries. This list includes not only close allies of the U.S., such as Japan and South Korea, but also nations like Laos, Myanmar, Bangladesh, Cambodia, Tunisia, South Africa, Malaysia, Kazakhstan, Thailand, Indonesia, Serbia, and Bosnia and Herzegovina. With only a handful of trade agreements currently in place, the administration is anticipated to announce additional tariffs on many more countries. Trump, alongside Treasury Secretary Scott Bessent, indicated that these new tariffs would take effect on August 1st. The initial announcement of broad tariffs on April 2nd, dubbed Liberation Day, sent shockwaves through the markets. Although Trump temporarily eased the situation by pausing higher tariffs for 90 days, he still implemented a baseline 10% tariff on all trading partners. Now, experts are expressing concerns that if these higher tariffs are enacted after July 9th, they could potentially trigger a recession in the global economy. Trump's rationale for these tariffs is twofold: to reduce the trade deficit and to bolster U.S. manufacturing while safeguarding American jobs. He argues that these tariffs will motivate U.S. consumers to purchase more domestically produced goods, thereby increasing tax revenues and encouraging investment within the United States. But what is the current landscape of manufacturing in the U.S., and how has it been affected in recent months by the economic turbulence brought on by Trump's policies? Current state of manufacturing. In an effort to rejuvenate American industry, Trump announced a substantial $14 billion investment on May 30th, facilitating a partnership between U.S. Steel and Nippon Steel, which is projected to create around 70,000 jobs, according to the White House. The Trump administration has also pointed to investments made by various sectors, including automakers, technology companies, and even chocolate manufacturers, as proof of a manufacturing renaissance on U.S. soil. According to data from a U.S. Bureau of Economic Analysis, manufacturing contributed a staggering $2.9 trillion to the economy in the first quarter of 2025, reflecting a 0.6% increase compared to the same period in 2024. This positions manufacturing as the fourth largest sector in the U.S. economy, trailing only finance, professional and business services, and government. However, many experts caution that restoring the manufacturing sector to its former glory, when it was a dominant force in the U.S. economy, will be a formidable challenge. They highlight that the U.S. currently lacks several critical components necessary for a thriving manufacturing environment, such as a skilled workforce, adequate government support, and advanced technology. In the 1970s, manufacturing accounted for over 25% of the gross domestic product, GDP, but this figure plummeted to 13% by 2005. As of 2024, it has further declined to approximately 9.7%. In contrast, the finance, insurance, real estate, rental, and leasing sectors contributed 21% to GDP in 2024, followed by professional and business services at 13% and government at 11%. Manufacturing decline continues. The Institute for Supply Management, ISM, Manufacturing Index, commonly referred to as the Purchasing Managers' Index, PMI, serves as a monthly barometer of economic activity based on surveys of purchasing managers in manufacturing firms across the nation. This index is a key indicator of the overall health of the U.S. economy. The PMI tracks changes in production levels from month to month, with a reading above 50 indicating growth and below 50 signaling contraction. In June, the PMI registered at 49%, marking the fourth consecutive month of contraction, although the pace of decline has shown signs of slowing. At the beginning of 2025, the PMI was in a growth phase, recording 50.9% in January and 50.3% in February, before dipping below the 50 mark in March. In June, 9 manufacturing sectors reported growth, while 6 experienced contraction. According to Reuters, economists suggest that the uncertainty surrounding the post-July 9 landscape has left businesses in a position where they are unable to formulate long-term strategies. Employment in manufacturing. As of June 2025, the U.S. Bureau of Labor Statistics reported that approximately 12.75 million individuals were employed in the manufacturing sector. This figure represents an increase from 5 years prior, when around 11.95 million people were employed in manufacturing roles. However, current employment levels remain significantly lower than the peak of nearly 20 million manufacturing jobs recorded in the late 1970s, highlighting the long-term decline in the sector's share of employment in the U.S. In May, job openings in U.S. manufacturing rose to 414,000, up from 392,000 in April, yet actual hiring saw a decline, indicating uncertainties in the labor market related to the Trump administration's tariff policies. Global manufacturing landscape. The United States has experienced a decrease in its share of global manufacturing, with China now recognized as the leading manufacturing nation by value added. In 2022, China contributed $4.8 trillion to global GDP through manufacturing, while the U.S. followed with $2.7 trillion. Despite this, the U.S. remains a significant player in the global manufacturing arena, generating more manufacturing value than the combined total of the third, fourth, fifth, and sixth largest manufacturing countries, and it does so with a workforce that is considerably smaller than its competitors. What are your thoughts? As we navigate these turbulent times in the manufacturing sector, it's crucial to consider the implications of these tariffs and the future of U.S. manufacturing. Do you believe that the tariffs will ultimately benefit American workers and industries, or do you think they could lead to more harm than good? Share your thoughts in the comments below. 2. Impact of Trump's tax law and tariffs on U.S. factory investments. Imagine a scenario where U.S. factories are finally getting the break they've been waiting for, only to have their investment gains put in jeopardy by a tangled web of tariffs. This is exactly what's happening with the Trump tax law, which has brought a mix of excitement and uncertainty to the manufacturing sector. But here's where it gets interesting. While the business tax provisions in the law have been a boon for many producers, the president's unpredictable trade policy is threatening to undermine any potential boost in capital investment. And this is the part most people miss. The impact of tariffs on U.S. factories is a complex issue with far-reaching consequences that can be difficult to navigate. Many manufacturers had put their spending plans on hold earlier this year, citing uncertainty surrounding the tax and spending legislation, as well as the erratic tariff announcements from the Trump administration. In fact, some producers were so hesitant to invest that they put their plans on ice, waiting for clearer signals from the government before making any major moves. But now that the tax law is in place, the question on everyone's mind is, will the benefits of the law be enough to offset the negative effects of the tariffs? This is where opinions start to diverge, with some arguing that the tax law will ultimately lead to increased investment and job growth, while others claim that the tariffs will stifle economic progress. So, we have to ask, can U.S. factories really reap the benefits of the Trump tax law, or will the tariffs prove to be a major obstacle? We'd love to hear your thoughts on this issue. Do you think the tax law will be enough to drive investment and growth, or will the tariffs hold the manufacturing sector back? The answer to this question has significant implications for the future of U.S. factories, and we invite you to join the conversation and share your perspectives. 3. Will 90 deals in 90 days collapse disrupt global supply chains? Will supply chains be shaken if the 90 deals in 90 days initiative falls short? when the administration of former U.S. President Donald Trump announced its ambitious goal of achieving 90 deals in 90 days. Leaders in the supply chain sector around the globe prepared for significant disruptions. However, as the date of July 9th approaches, it becomes evident that the initial 90-day deadline has passed without even 9 agreements being finalized, leading to increased pressure and delays on already strained trade routes. The deadline has now been extended to August 1st, and discussions of further postponements only add to the mounting uncertainty in supply chains that have spent the last year navigating tariff barriers and attempting to predict the unpredictable shifts in U.S. policy. A recent survey conducted by Gallagher, a U.S. insurance brokerage, reveals that many American business owners are deeply concerned about potential disruptions to their supply chains due to President Trump's extensive tariffs. Patrick Gallagher, the chairman and CEO of Gallagher, shared with Reuters, "Our survey indicated that supply chain disruptions are a significant worry for business owners, with 90% expressing concern over the impact of tariffs on their operations." He further noted, "Global supply chains, already strained by geopolitical tensions and extreme weather events, remain susceptible to interruptions," highlighting that business owners are actively seeking ways to diversify their operations and protect themselves from possible negative consequences. Treasury Secretary Scott Bessent has indicated that the Trump administration is focusing its efforts on 18 countries that account for 95% of America's trade deficit. These nations include crucial partners like Japan, South Korea, Germany, and Mexico, all of which play vital roles in U.S.-centric supply chains. This week, the U.S. sent letters to several of these countries, but the contents were not groundbreaking. They merely reiterated a tariff formula first introduced in April 2025, which uses the size of the trade deficit as a rough gauge of alleged trade cheating. For manufacturers, supply chain managers, and procurement leaders, this situation keeps uncertainty at a high level and timelines compressed. The letters dispatched to key trading partners resemble the Liberation Day board that was once displayed in the White House briefing room more than they do traditional trade negotiation documents. Their message is clear: accept new tariffs or quickly offer concessions. Japan and South Korea were the first to receive these communications. Instead of fostering dialogue, these letters have reignited tensions. During a cabinet task force meeting on July 8th, Japan's Prime Minister Shigeru Ishiba expressed Tokyo's profound regret that the U.S. government has imposed additional tariffs and announced plans to increase tariff rates. South Korea's finance ministry issued a statement indicating that it would closely monitor the situation, but stressed that if excessive market fluctuations occurred, the government would take immediate and bold action in accordance with its contingency plans, although it did not specify what those actions might entail. Supply chains that rely on U.S.-Asia cooperation are now facing additional challenges. For U.S. importers, this could mean an increased risk of disruptions, delays, and changing cost structures. Stockpiling and substitution. The prevailing uncertainty has already altered behaviors on ground. In anticipation of the tariffs, importers increased their inventories, leading to temporary spikes in shipping demand. However, since then, shipping volumes have declined. Chinese exports to the U.S. have decreased by 9.7% this year, reflecting not only a drop in demand, but also intentional efforts to shift sourcing strategies. In contrast, China's exports to Africa have risen by 18.9%, to ASEAN countries by 12.2%, and to the UK by 7.4%. As the U.S. intensifies its protectionist tariffs, now estimated to be at an effective rate of 15%, a significant increase from the historical range of 2 to 4% over the past 4 decades. Trading partners are exploring alternative markets. Global manufacturers are beginning to adjust their production strategies. Logistics providers are revising their transportation routes, and procurement leaders are updating supplier briefs, often with a singular aim: to minimize exposure to the U.S. tariff system. Retailers, inflation, and changing costs. U.S. retailers have already alerted the White House about the repercussions of the tariffs. Their concerns extend beyond pricing, though that is certainly a factor. They are also observing longer lead times, shifting compliance requirements, and fluctuating sourcing costs. During the Treasury Secretary's confirmation hearing, he suggested that a stronger dollar would mitigate tariff-induced inflation. However, the dollar has depreciated by approximately 10% this year, exacerbating price increases throughout the supply chain. The outcome is a squeeze on both sides. Importers are paying more for goods, while domestic producers are facing rising costs for raw materials and components sourced from around the globe. David Zinsner, chief financial officer at Intel, remarked during a call with investors, "The fluid trade policies in the U.S. and beyond, along with regulatory risks, have heightened the likelihood of an economic slowdown, with the chances of a recession increasing." He added, "We will undoubtedly see costs rise." Are U.S. tariffs detrimental to global pharmaceuticals? In the meantime, President Trump is threatening to impose 200% tariffs on pharmaceuticals, prompting global health supply chains to prepare for potential disruptions, delays, and cost increases. The president has indicated that these new tariffs are part of a strategy to encourage more companies to establish operations in the U.S. While no specific measures have been implemented yet, the White House's investigation into pharmaceutical imports in April 2025 has set the groundwork for tariff actions based on national security concerns. "We will give companies about a year and a half to comply, and after that, they will face tariffs," President Trump stated during a cabinet meeting at the White House on July 8th, where he also mentioned potential tariffs on semiconductor imports. If they need to import pharmaceuticals into the country, they will be subject to very high tariffs, like 200%. "We will provide them with a certain time frame to get their operations in order." Jamil Ahmed, Director of Solution Engineering for Global Capital Markets at Solace, suggests a potential solution. Utilizing advanced data analytics along with a real-time overview of every fluctuation can enhance transparency, which is essential in the pharmaceutical sector. Managing a global supply chain is inherently complex, and the current economic climate, including tariffs, has made it even more challenging. Overseeing intricate supply chains can be daunting. Global trade response. For the moment, the global market remains stable, but the duration of this stability is uncertain. Ultimately, supply chains function on narrow margins and require long-term planning, so short-term stability offers little reassurance. David Weinberg, Chief Operating Officer at Skechers, noted during a post-earnings call with investors, "The current environment is simply too dynamic to plan outcomes with a reasonable degree of confidence. Delays like these disrupt every level of the global supply chain. Until clear agreements are reached, procurement and supply chain leaders must navigate the political turbulence or risk being swept up in the chaos." 4. Why Trump's tariffs haven't boosted U.S. manufacturing jobs. Economic Analysis, 2025. The surprising failure of Trump's aggressive tariffs to spark a manufacturing renaissance in America is a stark reality. While the full effects of these policies may still unfold, initial indicators show that not only have tariffs not led to a surge in manufacturing jobs, but they have instead created chaos and uncertainty among businesses. Economists and trade experts agree that the unpredictable nature of Trump's trade war is exacerbating the long-standing challenges faced by the U.S. manufacturing sector. Despite raising tariffs to levels not seen in nearly a century, the sector lost 14,000 net jobs in May and June, according to federal data. Since Trump took office, manufacturing employment has remained largely unchanged. In May, factory hiring plummeted to its lowest rate since 2016, even dipping below the level seen during the height of the COVID-19 pandemic. Job openings in manufacturing have also decreased by nearly 100,000 since Trump's inauguration, suggesting a bleak outlook for future hiring. Rather than providing a clear incentive to hire, Trump's erratic trade policies are causing confusion and uncertainty. Business leaders need long-term stability regarding tariffs, but under Trump's leadership, it remains unclear where tariffs will stand in the coming months, let alone years. It's a deliberate choice to create this level of uncertainty, and it comes with significant costs, says Betsy Stevenson, a professor of economics and public policy at the University of Michigan and a former chief economist at the Department of Labor under President Obama. Manufacturing executives report that the lack of clear rules is hindering their ability to predict demand and make hiring decisions. The tariff chaos has halted global and domestic sales. Everything is on hold, and orders have collapsed, notes one machinery executive from a recent survey by the Institute for Supply Management, ISM. Another executive echoes this sentiment, stating, "Tariffs, instability, a sluggish economy, rising prices, and geopolitical unrest are creating a nightmarish environment, and fatigue is setting in." Trump has imposed or threatened steep tariffs on numerous countries and industries. For example, he has proposed 50% tariffs on imports from Brazil, despite having a trade surplus with the country, and initiated a 50% tariff on copper, a vital raw material for manufacturers. Additionally, he has considered a 200% tariff on pharmaceuticals and a 10% tariff on BRICS nations. This whirlwind of activity underscores the unpredictable nature of Trump's trade policies. There hasn't been a revival in manufacturing because the president's tariff policy is creating a chilling effect, explains Hartika Singh, an economic strategist at Fundstrat Global Advisors. Companies are struggling to navigate this uncertain environment. It's important to note that the long-term impact of Trump's tariffs and associated legislation, such as the One Big, Beautiful Bill, which includes tax incentives for manufacturing, is still unknown. Building new factories takes time, and the White House maintains that Trump's policies have helped stabilize a sector that lost over 100,000 jobs during Biden's final year in office. However, the White House's argument faces criticism. Some experts, like Robert Lawrence, a senior fellow at the Peterson Institute for International Economics and a professor at Harvard University, are skeptical about the potential for a manufacturing hiring boom. These policies seem outdated and nostalgic for a time when manufacturing was a major source of employment. But that era is gone, Lawrence observes. Research indicates that manufacturing currently accounts for only 7.9% of U.S. jobs. Even eliminating the entire U.S. manufacturing trade deficit would only increase manufacturing's share of employment by about 1.7 percentage points to 9.7%. Furthermore, manufacturing employment has been declining for decades as the economy shifts towards services, particularly technology and finance. Since the 1950s, approximately 95% of job growth in the U.S. has occurred in the service sector. Manufacturing employment peaked at 19.5 million in 1979, dropped to 11.4 million during the pandemic, and recovered to pre-pandemic levels in 2022. However, it has since declined again. Beyond trade policy uncertainty, manufacturing faces additional challenges from automation and cheaper labor abroad. Chris Cox, CEO of toy manufacturer Hasbro, notes that producing toys in the U.S. is 50% to 60% more expensive than doing so overseas. Moreover, many factories struggle to attract skilled workers willing to take jobs in locations away from major urban areas. There's a paradox where 80% of Americans support a larger manufacturing sector, but only 25% want to work in it, Lawrence points out. A CNN poll in April revealed that 73% of Americans prefer office jobs over manufacturing roles with the same pay. Trump frequently attributes the decline in U.S. manufacturing to foreign countries cheating, but Lawrence's research suggests that this trend is universal across developing nations, regardless of trade balances. Ultimately, Lawrence fears that Trump's tariff strategies could backfire, making it more expensive to produce goods in the U.S. while alienating international customers and partners. We're positioning ourselves to be less competitive globally and risking the ire of our allies and largest markets, he warns. This situation raises important questions. Are tariffs the right tool for revitalizing U.S. manufacturing? Or should policymakers focus on fostering innovation, training a skilled workforce, and addressing the broader structural changes reshaping the economy? Your thoughts matter. What do you believe is the best path forward for American manufacturing? Share your views in the comments.